Look, I need you to understand something that's happening right now in the gold and silver markets. Something that most people won't realize until it's too late. And by too late, I mean the opportunity will have completely vanished. We're watching a window close in real time. Not metaphorically. Actually closing. And once it shuts, the people on the outside are going to spend years wishing they'd paid attention to what I'm about to show you. Let me paint you a picture of what's unfolding. Right now, there's a massive divergence happening between two worlds, the paper world and the physical world. And that gap, it's about to snap shut like a bear trap. In the paper markets, you've got traders pushing prices around with contracts that represent gold and silver that doesn't actually exist. Hundreds of paper claims on every single ounce of physical metal. It's a game of musical chairs where there are 1,000 people in 10 chairs. Works great until the music stops. But here's what's different right now. The physical market is screaming something completely different than what you're seeing on your screen when you check gold prices. Premiums on physical metal have exploded. Delivery delays that used to be days are now weeks. Some dealers are simply out of stock on certain products. The U.S. Mint has had to ration Silver Eagles multiple times recently because they can't keep up with demand. This is the window I'm talking about. Right now, you can still buy physical metal at prices that are somewhat connected to the paper market. But that connection is fraying. Fast. Let me tell you what happened in 1980. Gold hit $850 an ounce in January of that year. Adjusted for inflation, that's over $3,000 in today's dollars. But here's what nobody talks about. In the months leading up to that peak, you couldn't find physical gold anywhere. Coin shops were empty. Premiums went through the roof. People were paying 30, 40, sometimes 50% over spot price just to get their hands on actual metal. The paper price said one thing. But if you wanted to actually own gold, you paid whatever the seller demanded, because there were 10 buyers for every seller. The window had already closed for most people. They watched the price go up on TV while being completely unable to participate because there was no metal available at any reasonable price. We're seeing the early stages of that exact same dynamic right now, and most people are completely blind to it because they're watching the wrong signals. Central banks understand this. That's why they bought over 1,000 tons of gold last year, and they're on pace to exceed that this year. China, Russia, India, Turkey, Poland, they're not buying paper contracts. They're taking physical delivery, draining the available supply, moving it from west to east in the largest wealth transfer in modern history. Think about what that means. These are the most sophisticated financial players on the planet. They have access to information and analysis that you and I will never see, and they're converting their dollar reserves into physical gold as fast as they possibly can, not slowing down, accelerating. Why? Because they see what's coming. They understand that the current monetary system is living on borrowed time. When you're running trillion-dollar deficits as far as the eye can see, when you're monetizing your own debt, when you're weaponizing your currency against other nations, you're writing checks that eventually come due. And when they do, gold isn't going to be something you can just decide to buy one day. It's going to be allocated, rationed, unavailable at anywhere near current prices. Let me show you something that should terrify anyone paying attention. The COMEX, which is the major exchange where gold and silver futures trade, has been experiencing something unusual. The amount of gold in registered vaults, the stuff that's actually available for delivery, has been declining. Meanwhile, the number of contracts representing claims on that gold keeps growing. It's like a bank that has $100 in the vault but has written deposit slips for $10,000. Works perfectly fine as long as everyone doesn't show up asking for their money at the same time. But what happens when they do? We got a preview of this in March 2020. Remember when the gold market went haywire? Futures prices and physical prices disconnected by over $100 an ounce. People who were short gold futures were desperate to deliver metal to close their positions. But there was a problem. The metal was in London, the refineries were shut down, the planes weren't flying, and the contracts required delivery of specific bars in specific vaults in New York. The system nearly broke. The CME had to change the rules mid-game to allow different types of bars to be delivered. It was a band-aid on a structural problem, and that problem hasn't been fixed. It's gotten worse, because here's what nobody wants to admit. The paper market has created claims on metal that doesn't exist. And as long as everyone's happy trading paper, that's fine. But the moment people start demanding physical delivery in size, the whole thing falls apart. And that moment is coming. You can see it in the premiums. You can see it in the delivery delays. You can see it in the mint rationing. You can see it in central bank buying. All the warning signs are flashing red. This is your window. Right now, today. You can still buy physical metal at prices that are somewhat rational, but that window is closing, and once it shuts, you're going to be on the outside looking in while prices do things that seem impossible. Let me tell you about silver specifically because this is where things get really interesting. Silver has this unique characteristic where it's both a monetary metal and an industrial metal. It's used in solar panels, electronics, electric vehicles, medical applications, real physical demand that consumes the metal. It doesn't get recycled like gold. It gets used up. And here's the kicker. We're running deficits. The world is consuming more silver than we're mining. Every single year. That deficit has to come from somewhere. It comes from above-ground stockpiles, inventories that have been built up over decades. But those inventories are draining, fast. And unlike gold, where central banks hold massive reserves, there's no cavalry coming to save the silver market. When those above-ground stocks are gone, they're gone. And then what? Industrial users who need silver for manufacturing are going to compete with investors who want silver for wealth preservation, both bidding against a supply that can't increase fast enough to meet demand. The silver market is tiny. The entire annual mine supply is worth maybe $25 billion. That's nothing. There are individual companies worth more than the entire annual silver supply, which means it wouldn't take much money flowing into silver to completely overwhelm the available supply. And when that happens, the paper market is going to discover something painful. You can't make solar panels with a futures contract. You can't manufacture electronics with an ETF share. You need actual metal. And if there isn't enough actual metal to go around, the price is going to do whatever it takes to destroy demand. That means prices that seem absurd by today's standards. Now, I want to take a quick detour here because this is relevant if you're thinking about your retirement accounts. A lot of people don't realize you can actually hold physical gold and silver inside an IRA. It's called a gold IRA. You're not buying paper. You're buying actual metal that gets stored in a secure vault, but it's held within your retirement account. No tax penalties. No early withdrawal issues. I put together a free guide that explains exactly how this works. It's in the description below. If you've got $100,000 or more in retirement accounts and you're concerned about what we're discussing here, it's worth checking out. Shows you the whole process, what to watch out for, how to do it right. All right, back to what's happening in these markets. Because there's another piece of this puzzle that's absolutely critical. The dollar. Everything we're talking about exists within the context of the dollar being the world's reserve currency. That status has given the United States extraordinary privileges. We can run massive deficits because the world needs dollars to trade. We can print money because there's always demand for those dollars. We can sanction other countries because they need access to the dollar system. But that's changing, rapidly. The BRICS nations are building alternative payment systems. They're settling trade in their own currencies. They're reducing their dollar reserves. This isn't speculation. This is happening right now. China and Saudi Arabia are doing oil deals in yuan. India and Russia are trading in rupees. The UAE is accepting yuan for oil. Every time that happens, it reduces global demand for dollars. And when demand for dollars falls while the supply keeps increasing, there's only one possible outcome. The dollar loses purchasing power, which is just another way of saying everything priced in dollars gets more expensive. Gold and silver aren't going up in some absolute sense. The dollar is going down. And as that process accelerates, as more countries move away from the dollar system, the price of gold and silver in dollar terms is going to reflect that loss of purchasing power. But here's the critical point. That repricing doesn't happen smoothly. It happens in steps. Long periods of consolidation followed by explosive moves higher. We saw it in the 1970s. Gold went from $35 to $200, then consolidated for years, then exploded to $850. We saw it in the 2000s. Gold went from $250 to $1,000, consolidated, then pushed to $1,900. We're in one of those consolidation phases right now. Gold has been range-bound for a while. Silver even more so. And that's exactly when you want to be buying. Not when it's making new highs every day and everyone's talking about it. When it's boring. When nobody cares. When the window is still open. Because once the next leg up starts, it's going to move faster than most people can react. You'll wake up one morning and gold will be up $200, then another $300 the next week, and you'll think, I should buy some. But when you call your dealer, they'll tell you there's a 6-week wait, or the premiums are 25% over spot, or they're simply out of stock. That's what happened in 2008 during the financial crisis. Silver eagles were impossible to find. Premiums went from $2 over spot to $6, $8, sometimes $10 over spot. And that was with silver at $15 an ounce. Imagine what premiums will look like when silver is at $50 or $100 and there's a genuine shortage. The window closes, and you're stuck on the outside. Let me give you another historical example. In 1933, Roosevelt confiscated gold from American citizens. Executive Order 6102. You had to turn in your gold, and you got paid $20.67 an ounce. Then, after they'd collected all the gold, they revalued it to $35 an ounce. Instant 70% devaluation of the dollar relative to gold. But here's what's interesting. There was an exemption. Rare coins. Collectible coins. Those you could keep. And in the years that followed, those coins became incredibly valuable. Not just for their gold content, but because they were one of the few ways Americans could own gold at all. Now, I'm not saying confiscation is going to happen again, but I am saying that governments do desperate things when their currencies are in trouble. And having some of your wealth in physical form, outside the banking system, outside the digital system, gives you options that other people won't have. Think about what happened in Cyprus in 2013. The banks closed. When they reopened, they took money directly from depositors' accounts to bail out the banks. If your wealth was in a bank account, you lost a chunk of it. No vote, no appeal, just gone. Or Greece. Capital controls. You couldn't move your money out of the country. You were limited in how much you could withdraw. Your wealth was trapped. Physical gold and silver don't have those vulnerabilities. Nobody can bail it in. Nobody can freeze it. Nobody can devalue it with a keystroke. It's yours, completely. And in a world where financial repression is becoming the norm, where negative real interest rates are destroying savers, where governments are increasingly desperate for revenue, that matters more than most people realize. But you have to get it while you still can, while the window is open, while the system is still functioning normally and you can buy metal at somewhat reasonable prices with somewhat reasonable delivery times. Because I'm telling you, that's changing. The signs are everywhere if you know what to look for. The premiums creeping higher, the delivery times stretching longer, the mint rationing, the central bank buying, the inventory drawdowns, the paper-physical disconnect. These aren't random events. They're symptoms of a system under stress, a system that's running out of physical metal while the paper claims keep multiplying. And when that system breaks, when the divergence becomes too large to ignore, the repricing is going to be violent. Silver could go from $25 to $50 in a matter of weeks. Gold could jump from $2,000 to $3,000 in a month. Not because of some fundamental change in the metals themselves, but because the paper price finally has to reconcile with physical reality. And physical reality is that there isn't enough metal to satisfy all the claims. Think about what that means for anyone who waited, who thought they'd buy when it was confirmed that prices were going higher. By the time it's confirmed, the easy money has been made, and more importantly, the metal might not even be available. This is the nature of these markets. They move slowly, then all at once. Years of consolidation followed by months of explosive gains, and the people who profit are the ones who position themselves during the boring times, when nobody was paying attention, when the window was still open. Right now, you can call a dealer and buy gold or silver and have it delivered in a reasonable time frame at a reasonable premium. That's the window. That's the opportunity. And it's not going to last. Because on the other side of this, when the repricing happens, when the shortage becomes obvious, when premiums explode and delivery times stretch to months, you're going to wish you'd acted when you had the chance. When it was easy, when it was boring, when everyone else was ignoring it. The smart money isn't waiting. Central banks aren't waiting. Sovereign wealth funds aren't waiting. Family offices aren't waiting. They're accumulating physical metal as fast as they can because they understand what's coming. They see the same data you're seeing. They just have the experience to know what it means. And what it means is that we're in the final stages of a monetary system that's been in place since 1971. Since Nixon closed the gold window and turned the dollar into a pure fiat currency backed by nothing but faith and credit. That system has lasted 50 years, but it's reaching its limits. The debt is too high. The deficits are too large. The money printing is too extreme. And the rest of the world is losing faith. When that faith breaks, when the dollar loses its reserve status, when countries stop accepting dollars for real goods, the repricing of gold and silver is going to be historic. We're not talking about gold at $3,000 or $5,000. We're talking about gold at levels that seem impossible today. Because it's not really about gold going up, it's about the dollar going down. And there's a lot of downside left in the dollar. But you can't wait until that's obvious to everyone. By then, the window will be closed, the metal will be gone, the premiums will be prohibitive. You'll be stuck holding dollars that are losing value while watching gold and silver soar to levels you never thought possible. This is your moment. Right now. Today. The window is still open. You can still act. You can still position yourself for what's coming. But that window is closing. Fast. And once it shuts, the opportunity is gone forever. The question isn't whether you believe everything I'm telling you. The question is whether you can afford to be wrong. Because if I'm right, and all the data suggests I am, the cost of inaction is going to be enormous. Not just in terms of missed profits, but in terms of lost purchasing power, lost wealth, lost security. Physical gold and silver are insurance against a system that's showing every sign of breaking down. And insurance is something you buy before you need it, not after. Once your house is on fire, it's too late to call the insurance company. The fire is starting. You can see the smoke. The question is whether you're going to act while you still can, or whether you're going to wait until it's too late, and then wonder why you didn't listen when someone was trying to warn you. The window is closing. The buy opportunity is shutting down. Not next year, not next month, right now. And once it's gone, it's gone. Make your decision accordingly.